Welcome to the Retirement Wealth Podcast. We're so glad you're joining us today. If you're feeling a bit overwhelmed by all the talk about retirement planning, you're definitely not alone.
Absolutely, Emily. It can be a lot to take in, especially when it comes to understanding concepts like the safe withdrawal rate.
Right? It's such a crucial topic for anyone planning for retirement, or even folks who are already retired.
Exactly. The safe withdrawal rate essentially helps you figure out how much money you can take out of your retirement savings each year without running out of funds. It's all about finding that balance,
And we're going to break it down today, making it easy to understand. We'll talk about what the safe withdrawal rate is, how to calculate it, and why it's so important for your financial peace of mind.
Plus, we'll share some tips on how to adjust it based on your personal situation, because everyone's retirement journey is a bit different.
So whether you're just starting to think about retirement or you're already enjoying it, there's something here for everyone.
And remember, it's all about making informed choices that align with your goals and lifestyle.
Exactly. So let's dive in, starting with what the safe withdrawal rate really means and how it came to be.
Emily, with everything that's happening in the economy right now, it's more important than ever to really nail down our safe withdrawal rate. Think about it. People are facing some pretty tough decisions as they approach retirement.
Absolutely, David. With inflation being a constant concern, it's crucial for folks to understand how that impacts their savings and spending power. If someone retires today, they might be looking at a very different financial landscape 5 or 10 years down the line.
Right, and I've seen it firsthand. Just last week, I had a client, let's call her Susan. She's planning to retire in about 3 years, and with the rising costs of everyday goods, she was really worried about how long her savings would last. We had to take a hard look at her withdrawal strategy.
That sounds challenging. What did you advise her?
Well, we talked about adjusting her safe withdrawal rate to account for inflation. She had a plan to withdraw 4% annually, but considering current inflation rates, I suggested we reevaluate that. It's not just about withdrawing a specific percentage anymore. It's about making sure her money keeps up with rising costs.
Yeah, I imagine that can be a bit daunting for many. And then there's the market volatility to consider, right?
Exactly. The market's ups and downs can really throw a wrench in the works. Take another client, Tom. He retired in 2020, right before everything went haywire. He thought he had a solid plan, but with the market dipping, he faced a tough choice. Withdraw less or risk running out of money sooner than he anticipated.
That's a tough spot to be in.
It really is. We had to shift his strategy to a more conservative approach, at least for the time being. It's all about balancing risk and ensuring he doesn't outlive his savings.
And speaking of balancing, I know taxes can also play a big role in how much retirees can actually keep.
Oh, definitely. With potential changes in tax laws looming, it's vital for retirees to think about tax efficiency in their withdrawals. For instance, if someone is withdrawing from a traditional IRA, that money is taxed as ordinary income. If they're not careful, they can find themselves bumped into a higher tax bracket.
Right, and that can really impact their overall financial picture.
Exactly. I worked with Laura, who was surprised to learn how much her tax bill would increase if she withdrew too much too soon. We ended up strategizing to pull from her Roth IRA for a few years, allowing her to minimize her tax burden while still meeting her retirement needs.
Such a smart move. And then there's Social Security, which is also a big topic. With all the discussions about changes to benefits, folks need to be aware of how that fits into their overall retirement plan.
For sure. I had a couple, Mark and Jenna, who were planning to take Social Security at 62. But after discussing the potential benefits of waiting, like increased payments later on, they decided to hold off. It might mean a tighter budget now, but it could pay off big time in the long run.
That's a great example of how long-term planning can really make a difference. And don't forget healthcare costs. They can be a significant expense in retirement.
Absolutely. I always remind clients to factor in those rising healthcare expenses. A recent study showed that a couple retiring at 65 can expect to spend over $300,000 on healthcare throughout retirement. That's a hefty sum, so building that into their withdrawal strategy is essential.
Wow, that's a shocking number. I can see how that would make someone nervous about their financial security.
Yes, and it's not just the numbers. It's the emotional side of it too. Many people worry about being a burden to their loved ones or running out of money. It can create a lot of anxiety.
It really can. I think that's why having a solid plan is so important. It gives people peace of mind, knowing they've got a strategy in place to handle what life throws at them.
Exactly, and that's where legacy planning comes into play. People want to leave something behind for their children or grandchildren, and knowing how to withdraw safely while still setting aside funds for future generations is a delicate balance.
It's like a juggling act, isn't it? Balancing current needs with future goals.
Very much so. And with the current economic trends, it's even more critical. We're seeing shifts in the job market and changes in how people view retirement as a whole. It's no longer just about saving enough. It's about adapting to a new reality.
So true. It's clear that understanding the safe withdrawal rate isn't just an academic exercise. It's a necessity for so many people navigating these waters.
Exactly. And it's not just about the numbers on a spreadsheet either. It's about crafting a life that aligns with their values and goals. Finding that balance can lead to a more fulfilling retirement experience.
So, David, with all this in mind, what are some core strategies that retirees can implement to ensure they're withdrawing safely and effectively?
So, Emily, when we talk about the safe withdrawal rate, a lot of folks often hear about the 4% rule, right? It's like a classic guideline for retirees.
Yeah, the 4% rule. I think many people assume it's a one-size-fits-all solution. But can you break down how that actually works?
Absolutely. The idea is that if you withdraw 4% of your retirement savings each year, adjusting for inflation, your money should last for about 30 years. So let's say you have $1 million saved up.
Right, that would mean withdrawing about $40,000 a year?
Exactly. But here's where it gets tricky. There are factors that can impact whether that 4% rate is safe for you personally. Like, what if the market takes a downturn in those early years of retirement?
Oh, that could really eat into your savings, huh?
Yes. That's why some advisors suggest a more conservative approach, especially if you're planning to retire early or if your portfolio is heavily weighted in stocks.
So what's a good alternative if someone is worried about that?
One alternative is the bucket strategy. It's a bit more hands-on, but it can give you peace of mind. The idea is to divide your assets into buckets based on when you'll need the money.
Interesting. So how would that work in practice?
Well, you might have one bucket for immediate needs, say the first 5 years of retirement, filled with cash or conservative investments, like bonds.
And then what about the longer-term needs?
Right. Your second bucket could be for the next 5 to 10 years, so maybe a mix of bonds and some equities. And then your third bucket, which you won't touch for 10 years or more, could be more aggressive stocks for growth.
That sounds smart. It seems like it gives you some flexibility and reduces the risk of having to sell investments at a loss.
Exactly. And it's all about having that balance. Now, on the topic of investments, let's talk about asset allocation.
Right. What should people consider when deciding how to allocate their assets?
A commonly recommended rule of thumb is the 70-30 portfolio, 70% in stocks and 30% in bonds. But, again, it really depends on your risk tolerance, age, and financial goals.
So a younger retiree might lean more toward stocks since they have time to recover from market dips?
Exactly. And as you get older, you generally want to shift towards more conservative investments to protect your savings.
That makes sense. Now, what about tax-advantaged accounts like 401ks or IRAs? How do those fit into the picture?
Good question. These accounts can help minimize your tax burden in retirement. With a traditional 401k or IRA, you'll pay taxes when you withdraw the funds. But with a Roth account, you pay taxes up front, and then withdrawals are tax-free.
So it's like a tax trade-off depending on when you want to pay taxes, right?
Exactly. And it's crucial to strategize when you withdraw from these accounts to minimize taxes. For example, if you have a mix of traditional and Roth accounts, you might consider withdrawing from the Roth first in the early years to keep your taxable income lower.
Wow, that's a good tip. And what about real estate? Is that something retirees should consider?
Yes, real estate can be a great way to generate income in retirement. You could either downsize to a smaller home and pocket the difference, or even consider renting out a property for passive income.
That sounds appealing, but what about annuities? I've heard mixed reviews on those.
Annuities can be useful tools for providing guaranteed income, but they come with fees and may not be suitable for everyone. It often depends on your overall financial situation and goals.
Got it. So it's best to weigh the pros and cons carefully.
Definitely. And let's not forget about Social Security. Optimizing when you take those benefits can significantly impact your retirement income.
How does that work? I know there are options for when to start taking benefits.
Right. You can start as early as 62, but your benefits will be reduced if you take them before your full retirement age. Waiting until 70 gives you the maximum benefit.
So if someone can afford to wait, it might be worth it to boost their monthly income later on?
Exactly. It can make a big difference in your overall retirement cash flow.
Speaking of cash flow, what are some withdrawal strategies that can help ensure people don't outlive their savings?
Well, aside from the 4% rule and the bucket strategy, we often recommend a dynamic withdrawal strategy. This means adjusting your withdrawals based on your portfolio performance each year.
So if the market is good, you could withdraw a bit more, but if it's down, you would take less?
Exactly. It's all about being flexible and responsive to market conditions to preserve your longevity in retirement.
That sounds like a balanced approach. But I assume there are pitfalls to watch out for too?
Absolutely. One of the biggest mistakes is failing to account for inflation. If you're only withdrawing a fixed amount each year, your purchasing power could diminish over time.
That's a huge point. And what about lifestyle inflation?
Yes, that too. Many retirees underestimate their spending needs. It's important to review your budget regularly and adjust your withdrawals accordingly.
Wow, there's a lot to think about. But with the right strategies, it seems like retirees can really make their savings work for them.
For sure, Emily. Retirement planning can feel overwhelming, but with the right knowledge and strategies, you can set yourself up for a fulfilling retirement.
Absolutely. And I think that's a perfect transition into discussing those common pitfalls.
Yes, let's dive into that next. So, Emily, when we talk about common pitfalls in retirement planning, one of the biggest ones that comes to mind is the sequence of returns risk.
Right, that's a biggie. A lot of people don't realize how crucial the timing of withdrawals can be. You could have a solid nest egg, but if you start withdrawing during a market downturn, it can really mess with your long-term plans.
Exactly. I had a client, let's call him Tom, who planned to retire in 2020. He had done all the right things, saved diligently, and felt prepared. But then the pandemic hit, and the market took a nosedive. He had to start withdrawing from his portfolio while it was down, and that really hurt his retirement savings.
That's such a tough situation. So what did he do?
Well, he had to adjust his lifestyle significantly. He cut back on travel, dining out, all the things he was looking forward to. It was a real eye-opener for him. And it taught him that even with a solid plan, the unexpected can derail your retirement comfort.
And that's where having a buffer or a strategy for those downturns can help, right?
Absolutely. It's about having a withdrawal strategy that accounts for those market fluctuations. You want to avoid selling investments at a loss if possible. Maybe having some cash reserves or a more conservative allocation as you approach retirement can be beneficial.
Speaking of allocations, another common mistake I see is poor asset allocation. Some folks get too conservative too quickly, while others stay too aggressive.
Right, I remember a couple, let's call them Jim and Linda, who were nearing retirement. They were heavily invested in tech stocks because they had done well in the past. But when the market shifted, their portfolio took a hit.
Ouch! How did they react to that?
They were understandably stressed. They had to rethink their entire retirement plan. We helped them rebalance their portfolio to include more bonds and other stable investments. It was a lesson in finding the right balance for their risk tolerance.
That's so important. You can't just stick with what worked in the past. You have to be flexible and adaptable.
Exactly. And, another pitfall I often see is ignoring taxes when planning withdrawals. People assume their tax rate will be lower in retirement, but that's not always the case.
Yeah, I've heard that before. It's surprising how many people overlook taxes on their withdrawals, especially from traditional retirement accounts.
Right. I had a client, Sarah, who was shocked when she realized how much taxes would eat into her withdrawals. She was withdrawing a significant amount from her IRA without considering the tax implications.
What did she do?
We sat down and restructured her withdrawal strategy to minimize her tax burden. By spreading out her withdrawals and considering other income sources, we managed to lower her taxable income, which made a big difference.
That's a great example of how planning can really pay off. And then there's the issue of healthcare costs.
Yes, healthcare can be a huge expense, and it's often underestimated. Many retirees don't account for the rising costs of healthcare or the potential need for long-term care.
I can see that leading to some serious financial strain.
I had a client, let's call her Barbara, who thought she had enough saved for retirement. But when she faced unexpected medical issues, her costs skyrocketed. She hadn't planned for that, and it put a real strain on her finances.
That's heartbreaking. So what can people do to prepare for those potential healthcare costs?
One approach is to consider long-term care insurance or even health savings accounts if they're eligible. Being proactive about these costs can really make a difference in the long run.
And then, of course, there's the Social Security claiming strategy.
Yes, claiming Social Security too early is another common mistake. I've seen retirees opt to claim at 62 because they think they need the income right away, but they miss out on those additional benefits they could earn by waiting.
It's like leaving money on the table, isn't it?
Exactly. I had a client, Mike, who claimed early and regretted it later. He could have waited just a few more years and received a much higher monthly benefit.
That's a tough lesson to learn.
It is, but it's a lesson many retirees face. The key is understanding the benefits of delaying those claims.
So what are some red flags people can look for in their own planning?
Well, if you find yourself making decisions based on fear or anxiety, that's a red flag. Also, if you're not regularly reviewing your financial plan or adjusting your strategy as your circumstances change, that's something to watch for.
Yeah, and I think if you're relying heavily on just one source of income, like Social Security, that's a sign you need to diversify your income streams.
Absolutely. It's about creating a well-rounded plan that can adapt to changes in your life and the market.
So for listeners who might find themselves in any of these situations, what's the best next step?
The first step is to review your financial plan and seek guidance if you're feeling uncertain. A professional can help you identify any gaps in your strategy and explore options you might not have considered.
That makes sense. It's all about being proactive rather than reactive, right?
Exactly, Emily. Taking control of your retirement planning now can save you a lot of stress down the line.
Great advice, David. This has been so insightful.
Glad to hear that, Emily. So, Emily, now that we've unpacked the safe withdrawal rate, let's dive into some immediate steps our listeners can take to apply this knowledge.
Absolutely, David. I think the first thing that comes to mind is, reviewing your current financial situation and retirement goals. It's like, you can't really plan if you don't know where you stand, right?
Exactly. Start by gathering your financial statements, your investment accounts, savings, anything that gives you a full picture of your net worth. And then think about your expenses. Have you considered using budgeting tools to track those?
Oh, for sure. Apps like Mint or YNAB can be super helpful for that. They make it easy to see where your money goes each month. Plus, it's a good way to identify areas where you might cut back if needed.
Right. And once you have that foundation, you can begin to experiment with different withdrawal rates. There are some great online calculators available. Vanguard, Fidelity, and Schwab all have retirement calculators that can help you run those scenarios.
That's a good point. I love how those tools can simulate various situations. You can see how your savings hold up with different rates of return or different withdrawal amounts. It's pretty enlightening.
And don't forget about Social Security. You can check your estimated benefits on ssa.gov. It's important to know what you can expect from that and when to claim it. Timing can really affect your overall retirement income.
Definitely, David. And speaking of income, if you haven't already, consider consulting with a financial planner, even just for a one-time session. They can help you fine-tune your strategy and ensure you're on the right track.
Yes, a professional can provide personalized guidance that's tailored to your unique situation. And if hiring someone isn't in the cards right now, there are plenty of books and podcasts out there that can provide valuable insights.
Oh, for sure. Books like The Bogleheads, Guide to Retirement Planning, or Your Money or Your Life are classics. They really break down complex topics into manageable steps.
And podcasts too. The Bogleheads on Investing podcast and Retire Inspired are great listens. They cover a lot of ground on retirement planning, investing, and financial literacy.
It's all about finding resources that resonate with you, right? And also building those habits. Just starting small can make a huge difference over time.
Absolutely. Consider scheduling a quarterly review of your portfolio. Just a simple check-in to see if your investments are aligned with your goals and adjust as necessary.
Yeah, and running those retirement projections regularly keeps you in the loop. It's like a little reality check to make sure you're still on track.
And remember, it's never too late to improve your plan. Whether you're just starting out or nearing retirement, small changes can lead to significant benefits down the line.
Exactly! Just take that first step. And if you feel overwhelmed, break it down into smaller tasks. You don't have to do everything at once.
Right. Just think about what you can tackle today. Maybe it's reviewing one investment account or setting aside a few minutes to read an article about retirement strategies.
And that can lead to even more steps down the line. It all adds up.
So with these tools in your pocket, you're ready to strengthen your retirement plan. Let's recap what we've covered today. Well, Emily, as we wrap up this episode, I think it's important to highlight some key takeaways from our discussion on the Safe Withdrawal Rate.
Absolutely, David. First and foremost, understanding the Safe Withdrawal Rate can really empower folks, right? It helps in determining how much money they can take out each year without running out.
Exactly. And it's crucial to remember that this rate isn't one size fits all. Each person's situation is unique, and adjustments may be necessary based on lifestyle, expenses, and market conditions.
Right. And speaking of adjustments, the importance of regularly reviewing your withdrawal strategy can't be overstated. Markets change, and so do personal circumstances.
Yes, and let's not forget the role of having a diversified portfolio. That can help manage risk, which is essential to sustaining those withdrawals over time.
Definitely. And finally, it's about peace of mind. Knowing you have a plan in place can really help you enjoy your retirement years without constant financial worry.
Well said, Emily. Building and protecting your retirement wealth is not just about numbers. It's about creating a future where you can thrive and enjoy life.
Exactly. So if you found today's discussion helpful, we'd love for you to like this episode, subscribe to our channel, and comment below with your biggest takeaway or any questions you might have.
And don't forget to share this with someone who's planning for retirement or already in it. They might really benefit from these insights.
Next time, we'll dive into how to rebalance your retirement portfolio. It's such an important topic and can really help ensure your investments work for you over the long haul.
Looking forward to it. Thanks for joining us today.
Yes, thank you all for listening. Until next time, take care and keep planning for that bright retirement future.